My sense is that there is a clear movement of money from physical savings to financial savings. And with interest rates being not so great or attractive, asset classes such as real estate also not being very lucrative in recent times, gold has got a somewhat mixed record. People have started looking elsewhere for returns. And one clear area where people are focusing, especially with a lot of media, I think, spotlight, is mutual funds. And that has resulted in the next generation also realizing that they need to create wealth for retirement and they need to put aside some money for a nest egg. And that is prompting people to look at this avenue for returns, and that is what is really driving the flow of money. The answer is that you need to go back to your drawing board. There is that thumb rule which says that you can subtract your age from 120 or 100, and whatever you get is the allocation you should make to riskier asset classes such as equity, right? So if you are say 30 and you should probably be putting 80 to 90% of your money in equity like products. Now this is a crude thumb rule. What is essentially pointing to the fact that you should be able to take more risk when you're younger and you should be taking less risk when you're older. Equity is clearly a riskier asset class, but when you take higher risk, technically speaking, at least in the long run, you supposedly get higher returns. And this is visible even for business owners. So you see individual businesses like shopkeepers, etc. If you look at a basket of them, over a long period of time, they've created wealth. They've been able to beat inflation. I think having a realistic expectation that equity class through mutual funds especially will give you a long-term return of something like 12% is reasonably sensible. And if you expect that fixed income will give you around 6 or 7% post-tax, that is also reasonably, I think, in the bag. But in recent times, we've seen that fixed income is not able to get those returns, and our return expectations from all asset classes have to come down simply because inflation has come down to newer levels. And if you put all this together, you start with asset allocation, and that asset allocation should drive your investment into equity, what portion, hybrid, what portion, and fixed income, what portion. Some of the themes you should look at, which people are less invested in, are the themes of the investment cycle as well as the rural resurgence story. Now these could really try your patience, because for many years now we've been talking about cyclical recovery. We've been seeing trends in rural India which look like an opportunity, but it takes time for some of these to manifest. Now this is the probable envelope through which you can look at investment ideas rather than looking at sectors. In the short term, there will always be sentiment as a factor. It expands PE if things are looking good to the market, and perhaps something on the back of people's mind is what could happen to the government. People like to see continuity. There is some expectation level from this government that it is a little bit more pro-business, or at least tries to get things done. At least that is the broad narrative. In terms of systemic reforms, they seem to be quite there in terms of visible reform which they have. Structural reform which they have done, and I think all of that seems to make an impact on the market, and so continuity is something the market is looking at. And if the prospects of the ruling party seem to have picked up, that may be one of the factors for this particular rally. But as I said, it's a short-term factor, and rather than dwell on the market, one should focus on the fund one is invested in. One should focus on the stocks one is invested in, because these are macro factors and they may not last for long. And as somebody said, politics, 1 week is a very, very long time in politics. So to decide something on the markets based on what's happening today would be wrong. Focus on company fundamentals, focus on mutual fund fundamentals when you invest. There are several risk factors. I mean, you could simply have a new arrangement in the coalition. You could have an event in a particular state which could affect the prospects of one party versus the other. You could have an event vis-a-vis our neighbor. You could have something happening between US and China. So, I mean, there are a long list of risks which are out there, and all it takes is, over a period of time, as multiples build up and earnings are not coming in, all you need is a small trigger to sort of shake things up. So the better thing to do is, instead of trying to look at macro trends and trying to predict which way the market is going to go, it's probably better to look at a company with a good business and available at a reasonable valuation and hold it long enough to get the benefits of wealth creation. Sense is that RBI has been looking at the inflation, and it doesn't seem to be focusing too hard on what could happen with respect to what they could do in terms of at least cutting. So there is a possibility that they could be going soft for some time, but they have been in the past looking at longer term implications of a cut. So my sense is, it's even Stevens, in the sense that it's very difficult to say whether they're going to probably cut or they're going to pause.